Hello Deep Value community, thank you for joining me. Today I'm going to talk about Mr. Market, and in this video I'm going to talk about some do's and don'ts, practice versus theory, and a helpful guide on how to manage Mr. Market. If you're new to the channel, please subscribe now, because this is our value investing journey, and this way you can get my next video installment. So let's get started. Mr. Market is a caricature made up by Benjamin Graham. So the theory is that Mr. Market comes to you every day and he shouts out prices that are either too high or too low relative to the intrinsic value of the business. The concept is that Mr. Market doesn't get annoyed if you don't take him up on his offer, and Mr. Market will come back to you next day with the same offer or a different offer. Sometimes they're shockingly high and sometimes they're shockingly low. The point is that the way the Mr. Market comes about is somebody that you are able to take advantage of when the price is either too low or sell to when the price is too high. Now, when Ben Graham thought about Mr. Market, it's a slightly different investment period, because at that time not as many market participants were following the stock market. So the market was significantly more mispriced, in my opinion, than it is today. This does not mean that there are not large mispricings happening all the time. There certainly is. But you have to make the assumption that because it's a global market and the information gets disseminated much quicker nowadays, you cannot just say, oh, this stock is too cheap and therefore it's undervalued. No, it could be cheap for a reason. So you have to be very, very critical of yourself when you invest. Think about the business, think about its relevancy over the next 3-4 years. Will that business be stronger in 3-5 years time, or will that business just kind of plod along? If it plods along, it can still be a worthwhile investment at the correct price, but it's important to realize that the competition is so intense nowadays. So the analogy of Mr. Market, it's not as clear cut as it was historically. So to conclude this section, I believe it's very important to be able to be reflective of your own strategy, and do not assume that the person that you're buying from or selling to knows anything less about investing than you do. For instance, let's say that you're buying a stock because you believe it's undervalued. On the other side, there's somebody selling you a portion of that business. Now, don't make the assumption that you know more than somebody else. And it's not good enough to say, I've got a longer term horizon. You've got to be able to figure out why that person selling you the business is wrong. And it's difficult. That's very, very challenging. And it comes with practice. It can be done, but it's important to not just have the blanket assumption that, oh, the person selling me that business knows nothing about investing. Because that person can be very, very savvy, and they might have seen something that you might not have seen. So let's move on. When markets collapse, as it did just recently in 2020, you're going to have extreme doubt. You're going to be wanting to sell your business. There's going to be panic. You're going to be bombarded by information telling you that you should sell. And there's this compulsion that you must act because there's so much information. Jim Cramer says something, Warren Buffett says something, and it's like you got all this bombardment and you feel like you got to do something. The share price is moving down or up, or you got to do something. You don't. Someone else's actions in investing do not dictate your own actions. So it's important that you do a lot of work before buying into a business, so that when that market sell-off comes, you don't doubt the ability of your business to withstand global economic contraction. So it's important to understand the strengths and weaknesses of that underlying business, because the business is going to have a bad quarter or even a bad couple of quarters. Does that mean that the business model is eroding? Does that mean it's just a temporary setback? What does it mean? Just missing the earning consensus doesn't mean much. What matters is the underlying performance of the business. So let's move on to some advice. The best advice I can give you is that you can outperform, but it's not going to be easy. The best way to do it is through consistent hard work. So consistent hard work does not mean just reading a couple of books at the weekend about how to invest. Consistent hard work is moving beyond the theory through reading 10Qs and 10Ks, these are your annuals and your quarterly statements by the company, spending time, burning up a bit of moonlight time to kind of go through those statements, read the management's discussions, try and understand how is the underlying performance of the business actually progressing. So it has to be consistent. You have to build up a thesis. So write down 2 or 3 ideas why you think your business is selling at a discount to what it should be. So 3 things that you should write. You should definitely write why you're buying it. You should definitely write what the business is about in 2 or 3 sentences. And you should definitely write what the intrinsic value of the business should be worth over the next 3 years. If you think that the business is undervalued by, let's say, I don't know, 15% over 3 years, that is not a worthwhile investment. There's not enough margin of safety. If you think that the business could go up, approximately 50% over the next 2 or 3 years, that's something that's quite attractive. If you think that the business is going to go triple in 3 years, that could be quite speculative. You're thinking that the market is so wrong that this business is going to just triple over the next 3 years. That's a very difficult investment to find. There's a lot of competition. So I hope you found that video about Mr. Market helpful and you'll subscribe. See you next time.